We are taking a complex stack of documents, everything from dense financial analysis to some really low-level engineering reports, and we're pulling out the core strategic insights just for you.
Today, we are wrestling with a classic tech dilemma. You know the one, revolutionary potential, but priced for absolute total perfection.
Right.
We're doing a deep dive into Cloudflare, that's ticker net, and asking whether their really cutting-edge AI infrastructure can genuinely justify one of the highest valuations in the entire tech sector.
Okay, let's unpack this. Our sources, they really present a fundamental tension. On one hand, Cloudflare has what looks like, well, unassailable technical superiority, but on the other,
Here's the price tag.
an eye-watering price tag that leaves almost no room for error. So our mission here is to connect that technical advantage to the cold, hard financial reality and figure out if the math actually holds up. Is this truly the future of computing, or is it just an extremely successful, extremely expensive bet?
Well, it all has to start with the tech. Because if the technology isn't radically different, then the valuation makes absolutely no sense.
Not at all.
When you look at Cloudflare, their entire competitive edge is built on one thing: efficiency at the edge.
Which brings us right to their AI moat. Looking at these technical reports, it's immediately obvious that Cloudflare is not playing the same game as, say, Amazon or Microsoft.
Not at all. The traditional hyperscalers, they're designed to rent out massive, centralized capacity. Cloudflare is optimizing its entire cost structure from the ground up for a distributed world.
And that optimization, it all seems to center on Infire engine.
That's it. Infire is Cloudflare's custom large language model inference engine, and the design choices they made are critical. It's written in Rust, which, in the development world is famous for its efficiency and memory safety.
So they can squeeze more performance out of less hardware.
Exactly. They get maximum performance out of fewer physical resources than their competitors.
And here is the number. I mean, this is the fact that is the entire foundation for this company's premium valuation. The core financial analysis suggests Cloudflare's AI infrastructure offers up to a 10 times cost saving.
A 10x cost saving compared to traditional hyperscalers.
Wait, if that's genuinely true, then Cloudflare isn't just competing, they're changing the entire unit economics of the AI industry.
Precisely. That 10x efficiency claim is the whole reason we're even discussing a PEG ratio this high. They achieve this by solving what's known in the industry as the GPU utilization paradox.
Explain that. What is that paradox?
So in these big centralized data centers, you have these incredibly expensive GPUs that are often bottlenecked. They're just sitting there waiting for slower CPUs or network delays to catch up. Cloudflare solves this by distributing the work.
How do they do that physically?
By running the inference models closer to the users, right on the edge.
Which cuts latency.
Instantly. And it maximizes utilization. The Infire system is engineered to minimize all that overhead. It caches the model waste locally on the edge node after the first download from their R2 storage system, so any future inferences start, lightning fast.
And R2 is their answer to Amazon's S3?
Right.
Just cheaper and built for this purpose?
Exactly. It's built to feed this edge network efficiently.
That makes perfect sense on paper, but I have to introduce some friction here, coming from the financials. A 10x cost savings sounds incredible, but is there any real evidence this is theoretical, or are customers actually achieving that yet? Because investors aren't paying for potential, they're paying a steep premium right now based on this claim.
That's a fair point, a really fair point.
Yeah.
And we are seeing quantifiable evidence in their recent enterprise wins, which we'll get to in a minute. That indicates the adoption is very real. But before we get there, there's also their supply chain advantage. Cloudflare can rapidly deploy capacity using off-the-shelf hardware, especially in major metro areas. This lets them scale up and start generating revenue much faster than competitors who are waiting on these massive, specialized, centralized infrastructure builds.
Okay, so that 10x edge is the moat. But that doesn't mean the giants, the trillion-dollar companies, will just sit there and watch Cloudflare eat their lunch.
Of course not.
So how are they fighting back? How is Amazon and Microsoft defending their turf?
We are seeing two very distinct, very powerful counter strategies. Amazon Web Services is trying to mitigate that latency problem with features like Lambda at Edge.
Which is part of their CloudFront CDN.
Right. It lets customers run code closer to the user. It's their version of the edge.
And Microsoft.
Microsoft is pushing a hybrid cloud strategy. They're basically telling their big enterprise clients, look, if you want the speed of the edge, just run the AI workloads on premises. You could use our Azure stack to do it.
That sounds formidable. I mean, especially for established companies who already have massive platform lock-in with those providers. If they can get edge performance from their existing vendor, why would they ever switch to Cloudflare?
And that's Cloudflare's core argument. They say they're integrated platform security, networking, developer tools, and now AI is designed to dismantle the fragmentation risk that comes with those hybrid models.
So when you try to cobble it all together yourself?
You introduce massive complexity, security gaps. It's a nightmare to manage. Cloudflare's integrated platform solves all of that with a single provider.
And the market seems to be validating this. I mean, the Q3 2025 enterprise wins you mentioned, those are pretty compelling proof points. They seem to be taking market share directly from rivals.
Absolutely. And we're talking about real money, significant clients. You have a $22.8 million deal with a Global 2000 media firm that they actually regained from a rival.
Regained, that's a key word.
It is. Then there's a $34.3 million European tech contract, specifically for shifting front ends to their serverless components, like Workers. And maybe most impressively, a $20 million plus U.S. cabinet-level agency contract, which proves they can compete on security and compliance at the highest level.
That brings us to the bigger strategic pivot here, the unified platform thesis, this idea of developer lock-in. Cloudflare is shifting from just a networking and security tool to a full-stack, AI-centric application development platform built entirely at the edge.
And this is absolutely critical for their future growth. Their recent acquisition of Outerbase, the developer database company, that was the final piece of the puzzle.
Why is a database company so vital to an AI edge network?
It completes the stack. You can't build a modern real-time AI application without a database backend. It's just not possible.
So this lets the developers on their platform.
It enables the 3 million active developers on the Workers AI platform to finally build complex, database-backed, real-time AI apps directly on Cloudflare's low-latency edge. They are now offering a seamless environment that competes head-to-head with these centralized cloud giants, but with that 10x cost advantage baked right in.
And their ambitions go way beyond just traditional hosting. They're trying to build the next generation internet infrastructure, the actual digital plumbing.
They certainly are. I mean, they're involved in the X42 Foundation for Digital Payments, which is aimed at creating an open internet standard. They plan to launch something called NetDollar, a U.S. dollar-backed stablecoin.
Okay.
But here is where it gets really ambitious. Agentic commerce.
That sounds like science fiction. What does agentic commerce even mean for the average person listening to this?
Think of it this way. In the near future, your personal AI agent is going to be shopping for you. It'll manage your subscriptions, make real-time financial decisions. Cloudflare is building the secure, high-performance rails, the authentication layer, the high-speed network that these AI agents will need to transact securely. You certainly don't want your financial AI using the cheap backroads when it's handling your net dollar.
So Cloudflare is positioning itself to host the zero-trust, AI-driven future of business itself.
That's the vision.
This all paints a picture of massive ambition, disruptive tech. But this brings us to the pivot we have to make. What does this all mean when we look at the balance sheet? Because the strategy is massive, but the valuation is, frankly, alarming. This is where we have to hit the financial reality.
And we have to establish the premium the market is demanding. According to an analysis from a financial firm, Cloudflare gets a grade of F on their value style score.
You'd F.
An F, meaning it trades at a massive premium to its peers. Look at the metrics. Their forward price to sales ratio is 26.19. That's 5 times higher than the industry average of 4.86.
That disparity on sales alone is staggering. But the single most critical, the most risk-defining metric in this whole analysis has to be the PEG ratio, the price to earnings to growth.
Precisely. Cloudflare holds a PEG ratio of 7.88. Now, you have to compare that to the industry average of 1.87.
So what is a ratio that high screaming at you?
It's screaming that the stock is priced for continuous, near-perfect execution and massive immediate acceleration in future growth. There is essentially zero margin for error baked into this price.
And that's exactly why the clear deceleration trend in their revenue growth becomes such a paramount risk. The price requires acceleration, but the trend is pointing in the opposite direction.
We can see that trend clearly laid out. Revenue growth has slowed from 33% in 2023 down to 29% in 2024, and the 2025 guidance is expected to be around 26.7%. When you have a PEG of almost 8, any continued slowdown, even a minor one, is going to trigger aggressive multiple compression.
And for those who don't spend their day in analyst reports, what is multiple compression?
It means the market instantly re-rates the stock. Investors just decide that the high price multiple, that 26x PS ratio, is no longer justified by lower growth. So they aggressively push the share price down until the multiple aligns with the new, slower growth reality. It's a rapid, often painful repricing.
So while the company holds a rank number 2, a buy from one financial firm based on estimate revisions and the 2025 EPS consensus was recently revised upward to 91 cents, that clear deceleration trend creates this fundamental tension. Technical superiority versus immediate financial risk.
To round out the picture, let's look at what the immediate market action is signaling based on a proprietary algorithm we track.
Right, we use a composite indicator we call the trending scoring algorithm. It's simple, really. It just measures the conviction and direction of a stock's trend using moving averages, momentum, and volume.
And as of the market close on December 24th, 2025, the algorithm assigned Cloudflare net a score of 1.0 out of 3.
1.0 out of 3.0.
Right. And the signal is a bullish long-term trend, but with weak short-term momentum.
What does a 1.0 score mean in plain language? What is that telling us?
It means the powerful long-term upward trend is still firmly intact. The 50-day moving average is well above the 200-day, which is a classic golden cross. That accounts for the 1 point.
Okay.
However, the short-term indicators like momentum and volume are sitting right on the fence. There is no high-volume institutional conviction pushing the stock higher right now, which means the stock is essentially in a holding pattern.
Long-term positive, but lacking short-term energy to break out.
Exactly.
That was a fascinating journey, taking us from Rust code optimization and the promise of 10x savings all the way to aggressive PEG ratios and technical scores. For you, the listener, looking to synthesize all this crucial information quickly, here is our deep dive lesson, the consolidated cheat sheet to help you understand these core tensions.
Let's start with the technology. What's the core idea?
The core idea is simple. Cloudflare's Edge AI, specifically that Infire engine, creates a genuine quantifiable advantage. It's offering up to 10x cost savings over the massive fragmented infrastructure of the centralized hyperscalers.
And what's the practical application of knowing that? What can you do with it?
Don't just analyze their past revenue growth. You need to quantify the potential future financial impact of that 10x cost savings on their market share. I mean, if they can really make AI inference 10 times cheaper, they radically change the playing field.
Next, let's hit the valuation. The key idea here is that their extremely high PEG ratio, that 7.88, means the stock is priced for continuous, near-perfect execution and a future acceleration that we haven't seen yet.
Therefore, the practical action is to use that PEG ratio as your primary risk metric. Any continued deceleration in revenue growth, which is currently trending down from 33% to 26.7%, will be aggressively punished by the market through that multiple compression we talked about.
And finally, strategy. The key idea is that the company is actively building developer lock-in. They're shifting from just a networking tool to a full-stack AI-centric application platform at the edge, cemented by acquisitions like Outerbase.
Which means your practical action is to watch the adoption curve. You have to monitor the successful integration of these new acquisitions and track the adoption rate of developer platforms like Workers AI. If that succeeds, the platform lock-in is real, and that 10x edge advantage really starts to compound.
Remember, being well-informed isn't just knowing the facts. It's about understanding the fundamental tensions between them. Is that 10x technical superiority powerful enough to overcome the 7.88 PEG ratio? That is the billion-dollar question.
To test your grasp of this complex deep dive, here are 2 short reflection questions.
Number 1. What is the primary technical reason Cloudflare believes it can maintain a 10x cost advantage over centralized hyperscalers and AI inference?
And number 2, why is the stock's current revenue growth deceleration so much riskier given its 7.88 PEG ratio?
Thank you for joining us on this deep dive.
Until next time, keep digging.